Hi, good morning, everybody. It is 10 a.m. on Wednesday, February 25th. I missed you last week. I was at a training event all the way on the other side of the country. Hours and hours of travel to go learn new things for you. It was very, very eventful for me, but I did miss you. So we're going to go through our normal process today, or our normal structure. We're going to have some updates from the Slott group, and then we're going to talk about the markets a bit. And then our financial focus this week is going to focus on estate planning. And the title is Estate Planning, Do This Now Before It's Too Late. And there's a really important reason for that. And I just realized that because my timer went off that I may have, again, started talking a little early. But estate planning is very important. And the title is Do This Now Before It's Too Late. And the reason I chose this week, because we learned early this week, just on Monday, that one of our clients passed away suddenly. Younger woman. It was very shocking to everybody. And as I was getting some water walking in here, one of our team members said, I just still can't get over this. So it always is, you reflect at these times, and it always makes you think of the plans that are out there. That's how I think anyway, like, okay, what's happening in our clients' lives and what plans are hanging out there. Because I'm going to talk about this more, but this person had recently joined our team, and she's actually been listening to this channel for about 3 years, and then finally engaged us fully as a client not too long ago, just in the beginning of the year, maybe towards the end of last year. But we're right in the midst of her estate planning, and thankfully we at least got some work done. But that'll make it easier on the family, but still much to be done. So I'm going to talk more about that at about the 30-minute mark. But good morning, everybody. Good to see you. But let's get into it. So remember my goals for you as listeners to this webinar or this podcast, if you're listening on the podcast. This is about education. I want you to be inspired to make changes. I want you to open your mind to different ideas and different ways of thinking about planning and investing. We just finished a class not long ago at the Holy Family University. So following up on the classes, I offer a 50-minute consultation to all the class attendees. So I have a lot of these scheduled coming out of the classes. And every time I'm talking to people who come from the classes or just reach out to us from the website or YouTube channel or whatever, I'm just reminded really how differently we do things. And I'm very, very proud of that. I'm proud of the team and the way that they think. But it feels like there's 90% of the population of financial planners, financial advisors who kind of do things the same way. And it's a little outdated and tired, in my opinion. And it certainly, in my opinion, isn't the best way to help people achieve their objectives in today's environment. So I want you to open your mind to different ideas and different ways about thinking of planning and investing. I want you to stay educated so you feel confident in the plan and strategies that are put in place. Because remember, when you're part of the small percentage that are doing things differently, the odds are against you from information point of view, because all of the marketing out there says do it the way you've always done it, do it. And I'm talking about estate planning, I'm talking about tax planning, I'm talking about how you manage your investments. It's just so different what I think needs to be done compared to what is done. So you feel you maintain that level of confidence in your plan by staying educated. So use this channel, use other resources to stay educated so you feel confident in the plan and strategies that are put in place. And of course, stay updated so you can make adjustments along the way, because things are always changing. So let's jump into the Slott Report. So today I pulled a couple different interesting articles I thought to share with you with the Slott Report. So let me share my screen here because I think it's helpful to read along. So this one's from just Monday, and this is from our friend Sarah Brenner. And Sarah writes, tax season is upon us. This is the time when many people consider contributing to a retirement account. You may be interested in the Roth IRA, which offers the promise of tax-free withdrawals in retirement if you follow certain rules. If you're deciding whether a 2025 Roth IRA contribution is the right move for you, here are 5 tips to keep in mind. I love these, 5 tips. Know the deadline. The deadline for making a prior year contribution. We're talking about contributions, not conversions. There's no such thing as a prior year conversion. So the deadline for making a prior year contribution to a Roth IRA for 2025 is April 15th, 2026. If you have an extension to file your taxes, that does not give you more time. Sooner is better than later. Don't wait until the last minute because you never know what may happen. Be sure to let the IRA custodian know the year for which you are contributing. That's an important point because if you just make a contribution and you write Roth contribution on your check, if you still use a check, or you don't note that it is for a 2025 contribution, well, the custodian may just assume it's a 2026 contribution. April 15th comes and goes, and you realize that it wasn't done right, and you can't go back. Interesting fact. Who do you not have to tell about your Roth IRA contribution? Let me read that again because when I first read this, I had to process it a couple times in my mind. So who do you not have to tell about your Roth IRA contribution? Well, that would be the IRS. There is no requirement that you report a Roth IRA contribution on your 2025 federal tax return. It is good practice, however, for you or your tax preparer to keep track of your Roth IRA contributions. Of course, you should absolutely keep track of your Roth IRA contributions. Number 2, understand your limits. If you are under age 50 in 2025, the maximum contribution that you may make to a Roth IRA for 2025 is $7,000. For those who reach age 50 in 2025, the maximum contribution limit is $8,000. The annual limit is aggregated for traditional and Roth IRAs. So that's important. That just came up on a phone call last week sometime. So the annual limit is aggregated for traditional and Roth IRAs. For example, you could contribute $5,000 to your Roth IRA and $2,000 to your traditional IRA. You may not contribute $7,000 to your traditional IRA and $7,000 to your Roth IRA for 2025. Number 3, you must have taxable compensation or earned income. You or your spouse must have taxable compensation or earned income to make a Roth IRA contribution. Passive income, such as investment income, will not work. Social Security income will not work either. Get this question all the time. Well, geez, I have real estate investments. I have dividends. I have interest. I have pension. I have Social Security. That all counts as income on your tax return, but it doesn't count as income for your Roth contribution. And I know it's not fair, right? But these are the rules, and that's how it works. All right. Number 4, don't count yourself out too soon. You are never too old to contribute to a Roth IRA. Do you already contribute to a retirement plan at work? That is not a problem. This is another thing that I hear all the time. Well, I already contribute to my 401k, whether it's traditional or a Roth. You can still contribute to a Roth IRA. So Sarah writes, that is not a problem. Your participation in your company plan does not affect your eligibility to make a Roth contribution. Consider the backdoor Roth contribution option. Your income must be under certain limits to make a Roth IRA contribution. If your 2025 modified adjusted gross income or MAGI, MAGI exceeds $150,000 if you're a single or $236,000 if you're a married filing jointly, your ability to contribute to a 2025 Roth IRA begins to be phased out. And then as you get beyond the complete phase out level, you can't make any contribution. If your income is too high, you might consider a backdoor Roth IRA contribution. You simply contribute to a traditional IRA, which has no income limits, but don't forget the taxable compensation or earned income requirement, Sarah says, and then you convert it. Sounds intriguing? Well, Sarah highlights, check with a knowledgeable tax or financial advisor to see if this is a good strategy for you. If you don't know one, I just might happen to have a resource for you. You can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com, or go to our website at attleborowealth.com and you can schedule time or just send in that question. All right. If you have pre-tax funds in any IRA, the pro rata rule will apply to your Roth conversion and to make part of your conversion taxable. So that's something to pay attention to, right? So it's kind of at the end of the sentence, but that's a big deal. So if you're considering a backdoor Roth contribution, you have to factor in the balance of all of your IRAs collectively, and you calculate those, and you have to divide it by the amount that you're contributing. That percentage you get is the only amount that is allowed. That's how you determine how much is taxable as part of that conversion or that contribution amount. I know it's confusing. That's why you have to work with somebody who understands the pro rata rules and understands if this makes sense for you or not. People get very, very excited about these and then end up, and the problem is that can be very, very complicated. Conversions of property and conversions of inherited IRA funds. So this is part of the mailbag, and Ian Berger answers these. So question, I really appreciate your emails and find them very helpful. Please continue the great work. This person writes, I read your advice and I read your advice in the recent Slott Report article that IRA contributions need to be in cash, but was wondering about Roth conversions. If I do a Roth conversion from a traditional IRA, can it be done by moving shares of a mutual fund from the traditional IRA to the Roth IRA? I would be paying the taxes out of personal funds. And he says, thank you. The answer is we appreciate the kind words. The cash requirement discussed in the Slott Report refers only to tax year IRA contributions. You are allowed to convert property such as shares of a mutual fund. If you are doing a Roth conversion through a direct transfer, the custodian will move mutual fund shares or other property from the traditional IRA to the Roth IRA. If you're doing the conversion through a 60-day rollover, you must roll over the same property that was distributed to you. That last sentence is important, of course. But when we're doing these in-kind conversions, you simply, and the reference here is mutual funds, but it can be stock, it can be bonds, it can be exchange-traded funds. It can be just about anything that is held in an account. So you just pick up the asset and you move it from a traditional IRA to a Roth IRA. And that's the conversion. Now, you have to be careful because, if you're trying to stay within a limit on your conversion, there are technically no limits, but just say your objective is to convert $100,000 this year, and you don't want to go over that $100,000. Remember, the values change, and in intraday often, or in the case of a mutual fund, at the end of every trading day. So you may end up notching over or under where you are. So just be aware of that when you're considering an in-kind conversion. And that's, again, people commonly don't understand that. They think you have to sell the position in the IRA and then convert it to a Roth IRA. Next question is, I am 74 and I have inherited both an IRA and a Roth IRA after my older sister died. Can I do a rollover from the inherited IRA into the inherited Roth IRA? And this is from Daniel. The answer is, Daniel, unfortunately not. Inherited IRA funds cannot be rolled over, convert it. I think that's what he meant was, instead of, people say that, can I roll over funds from a traditional IRA to a Roth IRA? And really what they mean is convert it. So inherited IRA funds cannot be rolled over, converted to inherited Roth IRAs. By contrast, inherited employer retirement plans can be converted to inherited Roth IRAs. Good distinction there. All right, that is our Slott Report for this week. So let's talk about the markets. So Lydia, again, did a great job. Our Chief Investment Officer, Lydia Amadei, did a great job, again, preparing us for this week's market commentary. So the markets major U.S. markets ended up in positive territory at the end of the week last week. But Lydia writes, however, performance under the surface was mixed, reflecting a broader market rotation as cyclical and non-tech stocks often led last week. Markets received a significant boost last week in the week following Friday's Supreme Court ruling against the U.S. government's recent global tariffs. This sparked a strong relief rally that erased the market's earlier losses. International markets were generally up for the week, with both developed and emerging market indices posting positive returns. So now we've got 4 bullet items that I highlighted here because I want to just make sure that we cover them well. So the gross domestic product, or GDP, growth data showed that the U.S. economy expanded at about 1.4% annualized in the fourth quarter of last year, which is slower than expected, missing consensus estimate of 2.8%. So the estimate was 2.8. It came in at 1.4. So that's showing economic expansion or growth coming to, less than expected. Inflation ticked higher. So now we see inflation higher. with personal consumption expenditures, or PCE. That's a separate index than what you might hear about CPI index, but personal consumption index rising 0.40 in December and 2.9% year over year, pointing to what they call sticky inflation. So this inflation could be around at this higher level than what the Fed wants and what we want to see as a whole for some time. Personal income and spending both rose 0.3%. Personal income and disposable income rose in December, while consumer spending also increased. So we're seeing economic growth slow. We're seeing inflation stay high. We're seeing income continue to rise and spending continue to rise. This data confirmed investors' concerns of persistent inflation. If it triggered an immediate repricing in the bond market, pushing Treasury yields higher as traders bet that the Federal Reserve would be forced to keep interest rates higher for longer, in quotes, higher for longer, well into 2026. So many people are already in their mind, and I think the analysts are getting away from it, but many people in their mind are, well, some analysts are getting away from it, but many people in their mind are thinking that interest rates are going to keep notching down because we saw some cuts in interest rates last year. So, yet to be seen. And there's a lot of activity going on, a lot of uncertainty in the certainly in the U.S. markets and the U.S. economy. Housing activity was mixed, with building permits and housing starts improving month over month, while new home sales declined slightly from November, but remained above levels from a year ago. Durable good orders fell slightly in December. Weekly jobless claims declined. Let's see. It was the largest single week drop in claims since November. So that's positive. The week so far this week. So yesterday we saw U.S. factory orders and durable good orders. Consumer confidence increased to 9.12% in February, up from revised January figures. This reflects a slightly more positive sentiment about jobs in the economy. However, confidence remains below longer-term peaks. So still a strong confidence in the economy by the consumer, but below what we've seen in the past. Today, we get NVIDIA earnings reports. That's after the market closed today. It is important to note, given recent rotation away from mega cap tech and rising anxiety over AI capital expenditures, this is going to be important to see what happens considering these. We're seeing concerns. We had this huge run up in tech and AI, and now we're seeing these pullbacks. And NVIDIA obviously is a leader in this area. And again, folks, this is for education. This is not a recommendation to buy, sell, or hold NVIDIA or any other position or industry or sector or economic region of the world. This is for education. So NVIDIA's results will either validate the continued spending on AI infrastructure or may trigger a broader tech sell-off. Let's see, Friday, we have the producer price index for January. This is expected to show a 0.3% month over month increase. This is the most critical macroeconomic data point of the week, Lydia writes. So the PPI measures wholesale inflation. Because these prices are eventually passed to the consumer, PPI is a leading indicator for the CPI and PCE inflation reports. Now, what's the sentiment out there among these large firms? I'd like to share with you some of the respected organizations out there and their opinions, and we try to piece together, let's talk about firms that are optimistic and bullish, right? Optimistic, we expect the markets to grow, and firms that are more pessimistic or bearish. So let's start with the optimistic side, the bullish side. JP Morgan is forecasting double-digit gains across both developed and emerging market equities for the year. So remember, when you hear equities, think stock. They anticipate the AI supercycle will continue to drive above trend earnings growth of 13% to 15% for the next 2 years, keeping the global economy highly resilient. Says JP Morgan. Keep swinging for the fences. AI is going to bring us home. We're seeing growth of 13 to 15% for the next 2 years. Again, they write, keeping the global economy resilient, highly resilient. Goldman Sachs expects global economic growth to hit 2.8% in 2026, above the consensus forecast of 2.5. They are specifically constructive on U.S. risk assets. I'll talk more about that in a second. Projected the U.S. economy will substantially, and they're projecting that the U.S. economy will substantially outperform global peers. They prefer equities over credit, noting that credit spreads offer limited upside. All right, so let's break that down a little bit, because there's a lot of financial jargon in there. So let's start with, they are specifically constructive on U.S. risk assets. What does that mean? Being constructive is financial jargon for being optimistic, right? So when you hear optimistic, or when you hear constructive, think they're optimistic, and that can also be bullish. Risk assets typically refer to investments that carry risk but offer higher potential returns, like stocks or corporate bonds, but mostly stocks. And again, when you hear equities, think about stocks. And then when you're talking about, the credit spreads, it's really, it's simply broken down. It's the value of the bonds. So Morgan Stanley's primary research arm remains highly bullish. So again, optimistic. Recently projected the S&P 500 could reach 7,800 over the next 12 months, roughly, which would roughly be a 14% gain. So we've got Goldman Sachs, JP Morgan, and Morgan Stanley all saying it's all looking rosy. Keep buying. Keep invested, keep buying. Now, again, not a recommendation to buy, sell, or hold any position, or even follow these recommendations, because on the other side of it, the Capital Group highlights the challenges of sticky inflation and a weakening labor market that could create economic drag in the first half of 2026. They are advising clients that this environment is ideal for shifting into high-quality bonds for downside protection. So this group is saying, look out, we've got economic drag in 2026, and geez, this is a great time to shift from risk assets, remember stocks and certain corporate bonds, and move to high quality bonds for downside protection, like U.S. Treasuries. So then we have Mark Zandi, who's the chief economist at Moody's Analytics, warned this week that the U.S. stock market and the broader economy may have become decoupled, meaning equities or stocks may not reflect underlying economic weakness. Zandi stated that elevated valuations, so I highlighted this, so hear me when I say this, elevated valuations and speculative behavior raised the odds of a significant market sell-off, and he specifically flagged vulnerabilities in employment and inflation data that may not support bullish equity valuations. So going back to the economic reports we're seeing, or that we're hearing, that's why I share these reports, this person's saying, well, wait a minute, inflation is higher. Consumer spending, the economy is dragging, right? Inflation is higher. The economy is dragging. And this information and the reports that we're getting and the data that we're pulling in is not supporting these maybe inflated stock valuations. And maybe inflated is a word I shouldn't say, but certainly bullish or optimistic equity valuations, stock valuations. But he said, Mark Zandi said, elevated valuations, so we can call it inflated valuations. So now what do you do with that? You've got JP Morgan, Goldman Sachs, Morgan Stanley saying, keep going, keep plugging along, stay fully invested. Then you have other well-respected organizations that say maybe cool our heels and move into, we're risk off, taking the risk off of the portfolios. Well, you build your portfolios to not even have to worry about listening to these folks. This is good education and this is stuff to digest. But when we can't get agreement by the brightest people on the street, so to speak, how does the average person, or a little boutique wealth management firm like ours, make these decisions? Well, you build it so that you don't have to rely on these analyst opinions for your day-to-day practices and day-to-day investment choices. And that is you have your financial plan drive your investment strategy, and you align, you've heard me talk every time about the 3 pillars of investment management. So you've got asset allocation, principal protection, and account segmentation, and what we call now our account segmentation income plan, because when you when you have your financial plan drive your investment decisions, we know exactly how much we need to spend at in each part of your life, and we break it down into roughly 3-year segments, those parts of life. And then when we have the information of the dollar amounts, and we're talking about planned expenses and unplanned expenses, we recognize that you can't plan out every expense, and you have to have contingencies. But when you've done the work and you identify what you need, well, then you can plug in how you should be invested for each one of these segments of time, and the money should be there when you need it, and that allows you to be to have these off-risk investments, like high quality bonds in the shorter term when you're going to need it, so you're not worried about market shock. And then you can have these more at-risk investments, right? Or these growth-oriented investments for later on in life when you can get past these swings in the markets, because these folks, these analysts appropriately are talking about what they think is going to happen in the next year, 2 years, maybe 3 years, right? But it's usually within 1 to 2 years. Well, we can't live and die by single year returns in the stock market or the bond markets or the real estate markets, any markets. We have to plan out accordingly. That's why we're long-term planners, and we drive our decisions based on those long-term plans. We understand that you need short-term access and short-term liquidity, and that's there. But we've got to have that plan for the next 3 years, the next 4 to 6 years, and all these segments along the way to do what you need to do. I hope that all makes sense. So we talked about the Slott Report. We talked about the markets. I'm going to just share with you here. Sometimes I like to share this with you. So let me pull this in. So this is a really great report that we get from Invesco, and I'll actually bring the screen down so I can share it here, or I can draw on it. So, okay, stay connected. Okay, good. So I like to share this. This is not a recommendation to buy Sarah Holt Invesco or use any of their investments. We love this report from the folks at Invesco because it's got a ton of data, and we only have this one page on here, but I think it's a 3 or 4 page report. It's just got so much data, so we use this a lot. But I'll share with you here. Here are you hear us talking about, well, the S&P 500 did this, the Dow Jones Industrial Average did this, the NASDAQ so-and-so, but sometimes it's just good to see the numbers. So let's just look at the numbers year to date. So you can see here's the Dow Jones Industrial Average. So for the last week, this is as of the week ended February 20th. So the Dow Jones Industrial Average was up 0.29%. It's positive 3.44% for the year. Now, it's February 20th. That's a really strong return in the Dow so far this year. The S&P 500 is not as strong, 1.09%. And people think that these are, essentially the same. And you'll see, and we've talked about this quite a bit, obviously they're not. And we know that the S&P 500 is largely driven by, the returns are largely driven by the top 7 positions right now, but you can see up for the week last week it was 1.11%. So that tells us that the S&P 500 was down for the year prior to just last week, where the Dow Jones Industrial Average was still positive for the year. The NASDAQ was up for the week 1.53%. Year to date is negative 1.47%, with a positive week of 1.53. The MSCI World Index was positive 0.99%. But look at the return here. So far this year, February 20th, 2026, up 8.44%. The emerging markets, 11.69, 8.77 for Europe, Asia, and the Far East. So you see these international markets are really, really strong. And now this doesn't mean that you should just jettison the S&P 500 or the Dow Jones Industrial Average, because these are U.S., right here. The NASDAQ, Dow Jones Industrial Average, and the S&P 500. Doesn't mean that you should jettison them and just say, oh, geez, I'm going to put all my money here. That's probably bad practice, right? Could work out in the short term. Who knows? We don't know, but it's probably bad practice. But it just goes to show you that when we're talking about broad-based allocation, if we use the that pie chart that we all like to refer to, you've got to have, and this goes back to the first pillar, broad asset allocation. You want proper asset allocation. So that's an important part of it. And I share in my 3 pillars videos all the time that 100% of the people who do this professionally, or even you individuals who do it on your own, you either have some sort of asset allocation. It's either purposeful or it just happens to be. But you can see that including broad assets in your asset allocation when you're talking about the stock market or even the bond market here is really, really important. So again, this doesn't mean you should flip to international markets. It doesn't mean that you should avoid U.S. markets. It doesn't mean, well, geez, U.S. markets, some of the U.S. markets are down. Maybe I should overweight them right now. It has to be a strategy that's built on purpose, and that purpose should be your financial plan. And then when we get to the details of the portfolio, we believe in strategic asset allocation, which tells us that for a certain amount of risk, you get a certain amount of return. And I'm happy to talk more about that with you if you have questions. But even if you go back to the video that we did, I guess a few weeks ago, it was right after we got back from our team trip in January. I had Lydia on, our chief investment officer, and she talked a lot about the U.S. markets and international markets. So you can go back to that recording and listen to that. But I just wanted to share some of the data that we look at on a regular basis. Now, remember, our investment committee team meets twice a week. Typically Tuesday, we talk about individual holdings for clients and accounts, and Friday is more of a strategy session. But one could bleed into the other. Now, interestingly enough, here they added Bitcoin onto this chart, and I like to see that because obviously we hear about Bitcoin all the time, and let's see where we are. So down, Bitcoin as a whole or itself is down 1.51% for the week last week, down 22% for the year so far, and year over year it's down 31%. So that's pretty substantial. Gold above it here was up 0.74 for the week, positive 16.54 for the year, and up 72% year over year. So again, you want exposure to many different areas in your broad-based portfolio. Okay, all right. So it's time to get into our financial focus portion of our webinar, and today is it's a really sobering topic here, because today we're talking about estate planning, and if you joined us at the beginning of the webinar, you heard me say that the weekly webinar, the financial focus, is kind of the last half hour or so of our weekly webinar. But if you joined us right at the top of the webinar, you heard me say that this topic today is driven by the sudden loss of a dear client of ours. And it was sudden. This was a person who has been watching this broadcast for a few years. They probably 3 years. They just recently engaged us toward the end of last year, and we just really got started for them with financial planning. So this was a complex plan, complex estate plan, complex income plan, and investment plan. But really in the midst of this planning process, and we learned about this loss, and here's what happens, just to give you a little bit of background. So when a client passes, or when we hear that a client is in bad condition, often they're going into long-term care suddenly, or hospice, or some issue, and we're concerned that we're going to deal with estate issues soon. The team rallies. We dig into the work that we've done, or the work that we're doing, make sure that everything's as buttoned up as possible, and see if there's any things that we need to address immediately. So that's what we did. We learned about this on Monday, and we all talked about the shock of it, because this was a younger person, and it was very, very sudden, very, very healthy person, and we got together, and I know I started going into the plan, looking at the plan, and I started looking at the individual documents that we had, just to get the process set in my mind. And it occurred to me, I started thinking, okay, well, thankfully, while we weren't able to complete her estate planning process, there are things put together, because this was the person out of the two spouses, this was the person who took care of everything, and that's a common thing. It's very uncommon that both spouses are equally involved, and it doesn't mean one spouse is smarter than the other or anything like that. It's just you pick up roles in relationships, and usually one spouse is kind of in charge or handles the finances, and the other spouse handles everything, or something else. When I said the other spouse handles everything, I was specifically thinking about my spouse. But in this case, this person was so her husband referred to her as the CEO of our family. And she was always the one in these conversations. And thankfully, while not complete, we didn't get a chance to complete her estate plan from our point of view. And from our process, things are much, much more organized than they would have been if this would have happened 2 months ago. So it occurred to me, and I just thought, okay, this is a good thing to talk about in the webinar this week. I had a completely different thing planned that I'll do another time, but I thought, okay, we need to have this conversation about what do you need to do in your estate planning? What needs to be done now? What should you do now before it's too late? So that's the title of this, estate planning. Do this now before it's too late. And I started putting things together, and one of the things I like to do from time to time is go out to the team, and the team. I said to them, that I'm going to talk about what happened on the webinar. What do you think? What do you think should be done immediately? What steps, if somebody already has an estate plan or they don't have any documents, what are some of the things that should be done immediately? So I'm going to share my screen with you here. So here's the responses. I copied and pasted them. So here's the team responses. So I went through some of the other bullet items, but these are the team responses here. So what should be done immediately? So Jessica, let's talk about Jessica's response. Hi, Jessica. So I'm going to just back up for a second, tell you my story with Jessica. Jessica and I, those of you who are clients already know this, but Jessica and I have been working together for just about 17 and a half years. So we started at a company called Wachovia. Wachovia failed, was taken over by Wells Fargo. We left Wells Fargo shortly thereafter, started this firm. And it was just the two of us for the longest time. And so Jessica spent, and not only have she and I have been working together for 17 years, but I think she was with the bank at Wachovia and all the iterations before that, about 15 years before that. So she is absolutely an expert of account management, account titling, account transfers, anything to do with accounts and especially banks and interrelations that we have with banks. So Jessica wrote TOD designations on non-IRA accounts. So let's just talk about that for a second. So TOD is transfer on death, right? So we transfer on death. And it is so this is non-IRA accounts. So Jessica says non-IRA accounts because IRA accounts have beneficiary designations, and you should always have a beneficiary designation. We still see people who come in and their IRAs, their life insurance policies, whatever, will say, as per my last will and testament. I don't know why attorneys still recommend this, but it's probably much better practice. Trying to be gentle, it's probably much better practice to name an individual that these beneficiary or these funds go to, because it's a direct transfer. So a TOD, a transfer on death, is an instruction of how you're going to transfer these funds when you're no longer here. So it's just like a beneficiary designation. So it does not have to go pass via a will. If there is no TOD designation on non-IRA accounts, so she's talking about basic brokerage accounts, investment accounts. And we'll talk about bank accounts in a second. But when we're talking about the transfer, it happens directly. So there's instructions on the account who this gets transferred to. It doesn't go to probate. It doesn't pass through the will. So it passes via contract or via operation of law. Now let me say this: I'm not an attorney. I'm a certified financial planner. We do a lot of estate planning for our clients. But these estate plans should also be reviewed by an estate attorney, and certainly documents, I believe, should be done by an estate attorney. There's a lot of websites you can go to create your own documents. Not a fan of that, but because there can be just too much confusion about individual property transfers. But back to Jess's comment, TOD, so transfer on death. So it acts just like a beneficiary designation. It tells where the property is going to go to or who the property is going to go to when you're no longer here. Now, these are for investment accounts. So think about your Charles Schwab accounts, your Vanguard accounts, your Merrill Lynch accounts, etc. Then with bank accounts, we have POD or payable on death. So payable on death is just like transfer on death. It tells the bank, gives the bank instructions, your instructions. You use their form to fill it out. Exactly whom those funds go to when you're no longer here. Doesn't pass through the will. Doesn't pass through probate. Very, very clear instructions. This is what we want. Is very, very clear instructions. So Jessica, great job. Thank you, Emily. So Emily's our lead financial planner. Emily's been here over 7+ years now. She was Merrill Lynch for several years before that. Emily wrote, reviewing and updating beneficiaries. So you all know, if you've heard me talk at all about estate planning, you've heard this over and over again, and Emily's spot on in mentioning it. Reviewing and updating beneficiary designations. It's something we do all the time. So every year when we do our financial planning for our clients, we go through and we review beneficiary designations, because even though we're certain in our knowledge about what these beneficiary designations are, we want to reaffirm it, and we go through just to make sure that computer systems haven't changed, documents haven't been shuffled, or whatever could cause these beneficiary designations to change. It's usually with accounts held outside that we see problems, but we review them every single year. So two things you should do right away. Check to see if TOD designations and POD designations are right for you. Now be careful. Let me go back to Jess for a second. I meant to mention this. So you can over POD and over TOD your assets. You want to leave some available for your whomever's administering your estate to be able to pay the expenses of the estate. But you can set that up too, right? You can you can have a certain amount and set up different accounts. There's nothing wrong with having multiple accounts for multiple purposes. So back to Emily, reviewing and updating beneficiaries. So where do you find beneficiaries? Well, you find beneficiaries on your IRA accounts, whether they're Roth or traditional IRA accounts. Your retirement plans. So retirement plans, 401ks, 403bs, your 457 plans, back to IRAs, SEP IRAs, simple IRAs. These all have beneficiary designations. Don't leave them blank. Don't say per my last will and testament. Name your beneficiary and perhaps name a contingent beneficiary, the people that will follow you if your primary beneficiary is no longer there. Life insurance. So there's life insurance policies have beneficiary designations. Annuities have beneficiary designations. All these are built into the platforms, IRAs, retirement plans, life insurance, annuity with beneficiary designations. They don't require the TOD or POD. It's the non-IRA accounts and non-annuities, non-retirement plans that require the TOD, POD, but both have the same effect. Direct your funds where you want them to go when you're no longer here. Emily continues to write, designating guardians for minors, of course. So who's going to take care of your children if you have minor children or kids with special needs? Setting up healthcare directives, making sure that somebody is going to be able to act for you if you're incapacitated. So not even if you pass away, but what if you're suddenly incapacitated? And establishing a durable financial power of attorney, same thing. Financially, who's going to help you or take care of you if you're incapacitated? Now, these go away, obviously, when you pass, right? But vitally important, because some people just don't die right away. Some people have a stroke and they're incapacitated. They can't work for themselves. They get in a catastrophic accident. They don't die. They can't act for themselves. So do these things now. Make sure you've got your documentation. Make sure if you set up your TODs, your PODs, if that works for you. Do these things now. Then Jesse wrote quite a bit. So let me pull this in here and see if we can, and I appreciate that. That wasn't a knock, Jesse. So identifying which accounts or life insurance policies can be assessed quickly to cover expenses if a high earning spouse passes away. Boy, that's a great one because these things take time. So here in southeastern Pennsylvania, specifically Bucks County, Pennsylvania, settling an estate can take on average 18 months. So that's the average. So some are faster, some are longer, but that's a long time to be able to have things locked up. And then if you have maybe a will that was done online and there's some confusion, or even if it's done by an attorney, things can get contested. It can take a long time. So Jesse, very astutely says, make sure that there's accounts or life insurance policies, because life insurance policies, if there's beneficiary designations, they pay out quickly. Within 30 days, maybe 60 days, there can be a substantial sum of money that comes to your heirs to help keep the lights on, help keep things going, less interruption on their life in a very difficult time. Because remember, this is a hugely emotional time for people in most cases. And then, then they have to deal with life still, their own life still, and maybe their kids' lives and things that are going on. So make sure there's some cash available. Highlight that life insurance with a designated beneficiary provides quick, tax-efficient liquidity to cover short-term expenses. So everything I just said, good. That's very good, Jesse. Ensuring both spouses have access to all accounts and maintain a beneficiary inheritance checklist. Really great. Like we do our financial planning checklist. There's a beneficiary inheritance checklist. There should be a list of assets and insurance contracts are held, and contact information for every account and insurance contract. So who's your attorney? Who's your contact? Many people will say they'll have a note in their estate plan, our clients, and they'll say call the Attleboro Wealth Management team. They have all of their information. And then Jesse suggested, and I have it pulled up. So the system we use has a vault. So what Jesse is suggesting is, share this, and I think it's a good idea. So what we call the plan tracker, I'm going to pull this down so you can see it here. And this is a sample client. I'm not sharing a real client. So this is a sample client. You guys might remember Frank and Joanna Miller. But what Jesse's talking about is have a list of names, have contact so that people can easily access things. And that's, by the way, with this person's situation, she passed away suddenly. We're not through her estate planning, unfortunately, but we have gathered all of her statements, all of her legal documents. Everything is in one place. Now, that was a big lift to begin with, because this person's, they've got a lot of assets. They've got stuff all over the place. And it took us a significant amount of time just to get a hold of all the documentation and have it in a category, or have it in a place where it can all be seen and accessed easily. So don't you think that that's going to be beneficial for the family while they're dealing with this, and the executor while they're dealing with this? Well, certainly. And as our clients, what they have is this vault. So this is the plan tracker that we use, and there's a vault in here for every client. And these files are, we've got taxes, shared documents, reports, legal, investments, insurance, deeds, advisors. All these things are filled out so that you could even give your executor, your power of attorney, access to this. They can have their own login information, and we're not selling you on the process here. I'm just sharing with you that this is something that should be done and accessible to the people that are going to be taking care of things when you're either incapacitated or no longer here. But you have all these things collected and categorized and set up so that it's easier for people to access. So that was a really, really good point. And Jesse writes, this is a huge benefit of working with a financial planning firm like Attleboro Wealth Management that provides both advice and secure record keeping via the vaults. Thank you for that shout out, Jesse. And number 3, open a conversation with family, spouse, and adult children about what happens if someone passes away. That may lead to changes in wills, creating a trust, etc. Great point. This conversation, open that conversation with the family. Okay, and I talked to my wife about this. If something happens to me, this is what I think should be done. And Jesse's point about this may lead to changes in wills, creating a trust, etc. Because you think of, here's a really good example of that just personally. My wife and I are real estate investors. We bought our first piece of real estate investment property when we were in our 20s. And so and it's mostly me, but her too. I've drug her along on this, but she, she has an interest in this, right? So, and she sees the value in these real estate investments for us and our family. My kids have zero interest in it, and they've let us know, please don't leave that real estate to us. So we know that this is something that we don't want to pass on to the kids, and we want, because there was a time when I had a provision in our will that said if there was any real estate, it's not to be sold. Our kids are to learn to manage it. Well, that would have been a bad situation for them because none of them have an interest in it. There's 4 kids. I just left out 2, but not in the will, just in that discussion in my mind. Okay, so open that conversation with your with the people in your life. Lydia writes, I'm shocked by how many people don't even have a basic will. I would also suggest periodically updating wills, ensuring that there is liquidity to cover near-term expenses like what Jesse said, funeral costs and inheritance estate taxes. So yeah, it is shocking, Lydia, and it's because it's a pain. It's a pain to find an attorney. You can do it. Again, it should be a lawyer to draft it, I believe. It's a lot of work. I shouldn't say it's a pain. It's a lot of work, and it's something that's uncomfortable. But you've got to step into the uncomfortable sometimes so that you can enjoy the rest of your life. And one thing that I don't think was mentioned, Emily talked about it, reviewing beneficiaries. And I'll come back to Sasha's comments for a second, but all these things should be reviewed every single year. You've heard me say this over and over again. You should be reviewing your financial plan every year. Of course, your beneficiary designations, like Emily said, but your entire plan, including your estate plan, because things happen within the year that might make you want to change your estate plan. And a really good example that we see on a regular basis is gifts to family members. So we'll have people that will come in and say, we gifted X number of dollars to this one child, and we want to create an offset in the will or the estate plan so that that's counted, that's removed from what they receive if they want to keep everything balanced within their family. Now, if you don't do that every year, if you don't have this conversation every year, that can easily get forgotten. Now, you might forget it, but I can almost guarantee you your kids aren't going to forget it. So they'll see the imbalance if they were expecting a balance when you're no longer here, or at some point. So Lydia, she's shocked at how many people don't even have a basic will. Yeah, get that basic will. Take the time, do the work to get that set up. Do it now. Sasha writes, make sure your executor or beneficiary knows where all the relevant documents are again. Give them copies if appropriate. The copies is a really good one. So we talked about the online vault. You can give your executor, your power of attorney, access. Well, with our system, you can give third-party access to your executor, power of attorney, etc. Not all systems are the same, but with our system, you, the client who is in charge of the system, can give access to whomever you want. The way you ask us to give them access. That's how it works. Or give them paper copies. And anytime you update it, give them paper copies. List of accounts again, contact information for a lawyer and an accountant and other relevant parties. So make sure that they know who to contact. If tax returns were self-prepared, let the executor beneficiary know where copies are. Because if there's no accountant involved who would have copies of previous tax returns and you're doing it yourself, let the executor or beneficiary know where copies are so they can go back and look at the last several years to see your financial situation from a tax return point of view. And this is a lot. I know it's a lot, but these are the things you should be doing now. You should, if you can't go through and listen to this video and check off these boxes and say, I've done that, I have that, I have that, I have that, go back and fill in the gaps because you just never know. You never know when this is going to happen. This was a big shock, certainly to that family. My gosh, that family's just devastated. But I want to tell you, it was a shock across Attleboro Wealth Management. Um, it very emotional, of course, but from a practical level, it probably made us all think, okay, is there anything we're missing for this person? And thankfully not, right? Um, but it certainly sparked this conversation. We see this a lot. Unfortunately, we've lost a lot of people. Some suddenly, some just over time, natural loss. But these are common things we see, and they're common things that we see with new people who come in. Thankfully, with our financial planning process, we help take care of these things, so that I hope that if you're a client, you're ticking through these boxes or these items and say, I got it. That's taken care of. That's taken care of. That's taken care of. But if you're not a client of ours and you haven't gone through this process, you should do it now, because you never know. It's Wednesday, February 25th, and we don't know what tomorrow brings. So I don't want to preach, but I'm going to preach a little bit. We all know what we have to do. Sometimes we don't know about these things like TODs and PODs. That's often new knowledge that I share with people in classes, and Jess shared with us here today. But beneficiary designations, you can't just kind of set it and forget it. You got to make sure that you're updating these things. Just go through this list and make sure that you've got everything taken care of, because you never know. All right. There's one question. Kathy. Good morning, Kathy. Kathy says, good morning. Question on non-IRA accounts. Difference between POD and ITF designation in trust for. ITF is in trust for. And if one is preferred or another. Well, you're not going to be surprised to hear me say it depends, right? So, Kathy, I'm happy to talk about that offline. You can send a question to questions, or you have our email. But it depends. It depends on all these structures is very specific. Remember any discussion here on this podcast, on this YouTube channel, these webinars, is for education. The specialized things that we're talking about, using POD designations, using TOD designations, how much to TOD or how much to POD, these are very individual decisions, and they should be reviewed with a financial planner or financial advisor who understands these things and can help you make these decisions. Or an estate attorney. Remember, I'll come back to one thing on the whiteboard, because I want to talk about your retirement team. This is a good time to talk about it. I always talk about you should have at least 3 organizations or people on your retirement team, and the first is a certified financial planner. You should have a financial advisor, but I think that financial advisor should be a certified financial planner. There's education and ethics requirements, and you've got to understand all the requirements within the CFP exam. Like, you can't be deficient in any part of the CFP program. So there's a level of proficiency that you have to show. That was the word I was searching for. There's a level of proficiency. So there's this long, arduous exam that only 50 to 60% of the people who take that exam pass. So there's a lot of financial advisors without that designation. And of course, I'm proud to hold that designation. But my question is, why would you work with somebody who hasn't gone through the work to achieve their certified financial planner designation? It is certainly the gold standard in financial planning. And it's also the only independent board certification, I should say. A lot of these other designations that you see are issued by organizations and schools and things like that sometimes you can achieve on a weekend. So so for those reasons, I think your financial advisor should be a certified financial planner. You're going to want a tax preparer, in my opinion. I know a lot of you like to do your taxes on your own, but I think there's a lot of value in using a tax preparer. And I think that tax preparer should be a CPA, for all the same reasons that I think your CPA should be or your financial advisor should be a certified financial planner. We have education, we have proficiency, we have ethics. All these things are vitally important when you're talking about appropriate, proper preparation of your taxes. And then you're going to need at least one attorney. I often recommend a certified elder law attorney if you have older parents, or if you're in your 50s or 60s. You may not be elderly now, but you want to make it to your elder ages. You may need other attorneys depending on what you have going on in your life, but at least one lawyer who's going to be an estate attorney. And the reason I recommend certified elder law attorneys is because there are a lot of good estate attorneys out there. There are a lot of great estate attorneys out there who know nothing about elder law issues, but I've never met a good elder law attorney that isn't also an excellent estate attorney. So you need somebody to draft your documents. Why not get somebody that's going to be with you for the long run? And then you want all these people working together and communicating on a regular basis for you, right? This is all about you. So that's really your retirement team. And when you have this group of people working together for you, then you really shouldn't be missing these things, right? These things we talked about. But these are the things that you should be doing now. Go through this like a checklist. I hope today was helpful. I hope this doesn't happen to you and your family, and I hope you're well prepared for when the time all comes for all of us. I hope we're all well prepared. Thank you, and have a great week, and we'll see you soon. Take care.